Hello everyone, greetings. Welcome to the Giant Markets, a podcast that focuses mainly on the finance side, the business side, and the entrepreneurship of this world. So, as we talked on the last episode, when I was giving you a brief analysis on how the candlesticks were happening. So today I want to talk to you and walk you through on on the candlesticks. I want to focus mostly on the candlesticks, give you a better introduction, give you how the characteristics that are happening when it comes to the candlesticks. So for what I have to know about this week is that this week has been a very volatile week in terms of the markets. The markets were so volatile. The U.S. Federal Reserve they decided to increase the their interest rates by 75 basis points. The British, they also decided to increase by 75 basis points also. But there were certain things that were said by Powell which brought confusion to the markets, and even what they was said by the British government also, it also brought confusion to the markets. But what we have decided to know is that regardless of whatever was said, in terms of the fundamental side, we have to be in a good position to understand the technical side. So the technical side of the markets is very important because anyone who wants to open the market has to have a clear view and understand how the markets are positioned. So as we are about to make an analysis and as you are about to do to start more of the candlesticks, because the candlesticks is a formation of it's an idea that was brought in by the Japanese. So they were trying to read the chart, they were trying to group up information through candlesticks, and we have collected that idea and brought it into the market. So anyone who wants to be a trader in the market has to have a clear understanding of how the candlesticks are written. So I will take you to this right. I will make you understand. I will make you have a rough idea, because as sooner than later I will open up a school of forex. So that's when I will go even deeper, trying to make you understand on how the candlesticks are, how you can read the candlesticks on the markets. But now I will just give you a rough summary to understand. But after this lesson, what I know is that your mind will be at a better position to understand how the markets they go. So just enjoy, because we are going to have a good time in understanding the candlesticks. What you have to understand about the candlestick is that these are further developed line charts. They serve to compensate for the disadvantage of less information. They are the preferred tool for any analysis for traders and most investors, since they provide all the required information. So today I want to teach you everything you need to know so that you become a candlestick master. The chart is made up of what we call price candlesticks. These candlesticks are made up of different components to describe the price movement of financial instruments. So let me give you two samples of candlesticks. Candlesticks consist of a solid part, the body, and the two thinner lines, which are called candle wicks or candle shadows. The length of the shadow shows how much the price has moved up and down within a specific duration time. So if we set our chart so that one candle responds to 1 week, then we can read the weekly fluctuation in the financial market using the shadow of the candlestick. So The other thing you have to realize about candlestick is that candlesticks, they come in colors. They are bullish, and the others, they are bearish. So the bullish ones are the ones that are green or white. So even here, if as you look at our chart, you can see that it is green. Then the ones that are bearish are the ones that are going down. They are red or they are black. So most of the time people like to use the red one or the black one. So when we're talking about the body, I think it's written there, you can see it in the body is there. And when we're talking about the shadows, are those those wicks or those lines that are on top there. So the candlestick body describes the difference between the opening and the closing price of the corresponding time periods. So you have to understand that a candlestick represents the opening. So as you can see there in the chart, there is an opening and there is the closing. But the opening of a bullish candlestick always starts from the bottom and closes at the top, because it's a candle that goes up. And the other one, the bearish, it always opens at the top, then it closes on the bottom, because it's that candle that goes down. So candlesticks are used for technical analysis, and candlesticks often offer more information and are the preferred medium for technical analysis. So for technical analysis, a lot of people like using candlesticks because because it gives you that advantage when you are trading. And so if you understand how to analyze and interpret the candlestick pattern, then half the job is understood in the financial market. So anyone who has understood the candlestick is far beyond in terms of analysis when you are doing the technical side. So candlestick can be divided into 4 elements, where each element reveals a different aspects of current trading behavior and privileging market sentiments. So now what I'm going to do, I want to show you the strength of the bulls and the bears. Understand the price and candlestick analysis, it helps of you imagining the price movements in financial markets as a battle between buyers and sellers. So this battle of buyers and sellers speculate that price will increase and drive the price up through their trades or their buying interest. Sellers bet on falling prices and push the price down while with their selling interest. So keep this in mind, knowing that any price analysis aims at comparing the strength ratio of the two sides to evaluate which market players are stronger in which direction the price is therefore more likely to move. So as you can see that in this picture, it's showing us the two sides, the strength of the bulls, which are the buyers, and the strength of the bears, which are the sellers. So there are characteristics of the analysis of these candlesticks bodies. A longer candlestick body that leads to a quickly rising price indicates more buying interest and a strong price movement. So as you can see, it's very bullish when it doesn't have those wicks. The first candlesticks from your left, it's very bullish because it doesn't have any of those long wicks. So if the size of the candlestick body increases over a period, then the price trend accelerates and trend is intensified. When the size of the body shrinks, this is that it's a prevailing trend comes to an end owing to an increased balance strength ratio between the buyers and the sellers. So when you are moving from the left side going to the one at the middle, it's the one that is showing that the 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 strength of the strength of the trend is shrinked. So whenever you find or you see that one which is in the middle, those ones that are in the middle, they are the ones that are showing no, now the strength of the candlestick has decreased. So candlestick bodies that remain constant confirm a stable trend. If the market suddenly shift from long rising candlesticks to falling candlestick, it indicates a certain change in trend and highlights strong market forces. So because these candlesticks, they go and shift as you are busy looking at the markets, but they talk a certain language that anyone who understands them can easily listen. So when you from the one that is on the left side going to the one that is in the middle, all these candlesticks, they are talking a certain language, and they are telling us, they are indicating to us the change in the trend. So that's why we have to dig deep and understand more about candlesticks, because it gives us that edge of understanding whether this market, this trend, is it now falling, or is it now going up. So here are the characteristics of the shadows of the candlesticks. So the length of the candlesticks are also very important because it helps in determining the volatility. So what I actually meaning is the entire range of the price fluctuation is easily seen and you can easily understand. So as we are looking in the first candle, the first candle is whole, it doesn't have any of the shadows. So let me focus more on these, or from the left, the second one from the left, the third one, the fourth one, and the fifth one from the left, because these are the ones that have shadows. So one of the characteristics of the candlestick shadows is that long shadows can be a sign of uncertainty, because it means that the buyers and the sellers are strongly competing, but neither side has been able to gain the upper hand so far. When you are this one, we are talking of it maybe when we are looking at the one that is at the middle, because of how it is represented. It doesn't have a body. So short shadows indicate a stable market with little stability. So any candlesticks that shows us about the short shadows, it is telling us the story of indicating a uncertainty in the market. So we can often see that the length of the candlestick shadows increase after long trend phase. This increase fluctuation indicates that the battle between the buyers and the sellers is intensifying, and the strength ratio is long on one side as it was during the trend. So what we have to understand about the candlestick is the healthiness of it. So when you are busy explaining this healthiness, the trends which move quickly in one direction usually show candlesticks with only small shadows. Since one side of the market plays dominant, players dominate the proceedings. So as we are talking more about the health of the shadows, you have to understand, like, why there is only 1 week on top, why there is the bigger week on the next candle, that is on the third from the left, and why there are 2 weeks from that candlesticks, that is a body, and 2 weeks from the top and the bottom. So that's how we understand the healthiness of the candlesticks. So anyone who has this proper understanding of the healthiness of the candlestick is quickly to understand the direction of whether who are leading in the market at that time. Whether is it the bulls, is it the bears, or it's just a tug of war between the bulls and the bear. So understand the price and candlestick analysis. It helps of you imagining the price movements in financial markets as a battle between buyers and sellers. So this battle of buyers and sellers speculate that price will increase and drive the price up through their trades or their buying interest. Sellers bet on falling prices and push the price down while with their selling interest. So keep this in mind, knowing that any price analysis aims at comparing the strength ratio of the two sides to evaluate which market players are stronger in which direction the price is therefore more likely to move. So as you can see that in this picture, it's showing us the two sides, the strength of the bulls, which are the buyers, and the strength of the bears, which are the sellers. So there are characteristics of the analysis of these candlesticks bodies. A longer candlestick body that leads to a quickly rising price indicates more buying interest and a strong price movement. So as you can see, it's very bullish when it doesn't have those wicks. The first candlesticks from your left, it's very bullish because it doesn't have any of those long wicks. So if the size of the candlestick body increases over a period, then the price trend accelerates and trend is intensified. When the size of the body shrinks, this is that it's a prevailing trend comes to an end owing to an increased balance strength ratio between the buyers and the sellers. So when you are moving from the left side going to the one at the middle, it's the one that is showing that the strength of the strength of the trend is shrinked. So whenever you find or you see that one which is in the middle, those ones that are in the middle, they are the ones that are showing now the strength of the candlestick has decreased. So candlestick bodies that remain constant confirm a stable trend. If the market suddenly shifts from long rising candlesticks to falling candlestick, it indicates a certain change in trend and highlights strong market forces. So because these candlesticks, they go and shift as you are busy looking at the markets, but they talk a certain language that anyone who understands them can easily listen. So when you from the one that is on the left side going to the one that is in the middle, all these candlesticks, they are talking a certain language, and they are telling us, they are indicating to us the change in the trend. So that's why we have to dig deep and understand more about candlesticks, because it gives us that edge of understanding whether this market, this trend, is it now falling, or is it now going up. So For better price understanding of movement and market behavior, the first two elements must be correlated in the third element. So during a strong trend, the candlestick bodies are often significantly longer than the shadows. So as you can see from here that there are places where the the bodies the bodies are bigger, so that's why they will be more, they are giving us that direction of going, or of telling us whether are we going to the top or we are going to the bottom. So during an upward trend, the candlesticks usually close near the high of the candlestick's body, and thus do not leave a candlestick shadow or have only a small shadow. So shadows are not they should be small, or they should not be visible whenever the trend is going up. For instance, like here in this picture, you can see that when it was going up on the right side, there were very small shadows that were visible for us to see. So during an uptrend, the candlestick usually close near the high of the candlesticks body, and thus do not leave a candlestick shadow or have only a small shadow. When the trend slows down, the ratio changes and the shadows become longer in comparison to the candlesticks bodies. So whenever it's trying to slow down, like you can see when you are coming down to this picture that you are looking at, as it's coming down, you can easily tell that the shadows were becoming very longer, because the trend was now changing direction, or it was in more powerful than it was when it was going up. So sideways phase and turning points are usually characterized by candlesticks that have a long shadow and only short bodies. So when you see a market telling you that we are in the sideways, it indicates of so many long shadows in one place, and but with small bodies, and this means there is a relative balance between the buyers and the sellers, and there is uncertainty about the direction of the next price movement. So these are the techniques and the qualities that you will find whenever you will be looking at the candlesticks in a live market. So we are only making a brief summary so that people can understand, so that you can easily understand like what is actually happening when we are talking of the candlestick having a big body, having a long shadow, or having a small shadow based on a picture before it can even happen on a proper market. So when you gel in and understand more about the characteristics of the candlestick, it will be easy for you to interpret even any graph that is happening, whether it's in the stock market, whether it's in forex. You can easily see it. The position of a body, you have to understand how the body is positioned. Right, so if you see only one dominant shadow which sticks out on one side and the candlestick body is on the opposite side, then the scenario is referred to as a rejection or a hammer or a pin bar. So this is where you will easily see the position of the body in the market. So we are going to talk more about the hammers, about the pin bars, and to make you understand more about how rejection come into place, because the shadows indicates that although the price has tried to move in a certain direction, the opposition of the market players have strongly pushed the price in the other direction. So whenever you will be looking, like you are seeing in this picture, whenever the shadows were becoming too many in one place, it's either it's either it's the buyers or the sellers that were pushing, that wanted to push the price down, or they wanted to push the price up. But if it's the buyers that wanted to push the price up, the buyers would refuse. How would you know that they have refused? By leaving a long shadow or a long wick, which is announcing that, but the buyers are still around in the market. So this is an important behavior pattern we will analyze in detail later. Another typical scenario shows a candlestick with two equally long shadows on both sides and a relatively small body. So we've talked about everything when it comes to the candlesticks, the things that you should know about the candlesticks, and what's the importance of the candlesticks in a chart pattern. So we'll explain even more further and go deep about the candlesticks, because the technicality of the candlesticks, they are very important for everyone to know them. But as we go further with these lessons, that's when we will be starting to take into consideration the pin bar, the morning stars, the shooting stars, and all those different types of candlesticks. So stay tuned to the next episodes that are coming, because they will be explaining more, going even more deeper about the candlesticks. Candlesticks are more important. Everyone has to know, has to have an understanding about the candlesticks, because before you could gel into the fundamentals, it's important for you to understand the technical side of everything, so that when you get into the fundamentals, it will be clear for you to understand. It has been a great week. We enjoyed the trading. I hope everyone enjoyed trading in this week. So stay tuned for the next lesson. I'm Daloboshe, and I'm signing out.